Okay, inheritance tax, the basics. It is a tax charged on the value of your estate when you die, if it's over a certain limit. To work that out, it's basically everything you own less everything that you owe. So assets versus liabilities. Sometimes, though, inheritance tax is also paid on gifts that you make during your lifetime, and we'll cover that very briefly. So how's the bill calculated? As I said, total value of your assets less the total value of your debts equals the value of your estate. The value of your estate less £325,000 is the amount that would attract inheritance tax, because £325,000 is the current nil rate band on which you don't pay inheritance tax at all. And the IHT chargeable on your taxable estate is 40%. I think we all know that, hopefully. But just to give you some idea of the figures, and it allows me to play with this little red button, if we take someone with a taxable estate of £500,000, it's not a lot of money in this day and age, they're going to pay £70,000 in tax and lose 14% of their estate. If you go up the top end, a £2 million estate, you are going to pay £670,000 of tax. Now, I don't know about you, but we all go through life and hopefully we pay our taxes, national insurances, etc. They leave one of the biggest taxes right till the very, very end. I love this one. Inheritance tax is a voluntary levy paid by those who distrust their heirs more than they dislike the Inland Revenue. Anyone know who said that? I think it's Eric Morecambe and Frank Carson, sort of a makeover job. But he's right, because if you talk to accountants, and I am not an accountant, by the way, I am a financial advisor, independent, but I work for a firm of accountants, and lovely they are too. They will tell you that inheritance tax is a voluntary tax, and you don't have to pay it. So what can be done to reduce this bill? First of all, you could do nothing, actually. You know, you can actually, we've heard about it, the ski club, spend your kids' inheritance tax. You could actually turn around and say, yes, okay, when I die, I am going to pay inheritance tax on my estate, but my children are still going to get a fair whack, and it's much more than ever I got from when my parents died. So if they're going to end up with an estate of £2 million and pay 40% and get 1.2 million, that's all right by me. Yeah. You could spend it. You could just try and spend your estate. Go through it all. As we get from another great quote here, George Best. Can you read that at the back? In case you can't. I spent a lot of money on booze, birds and fast cars, and the rest I just squandered. So try and do your best. George Best, that is. That wasn't a pun. Make a will. Sorry, Will, but yes, Will said make a will. You should make a will. You can make use of will trust because, and correct me if I'm wrong because I am not a techie, a lot of people think now when they make wills that they don't have to create a will trust using their nil rate band, their first 325,000, because if they don't use it, it goes to their spouse because the Conservative Party doubled up on the nil rate band, so that on second death, if the wife, and I always choose the wife because she survives the man, if the wife dies second and the husband hasn't used his nil rate band, she can use his nil rate band. But if the government get rid of that tomorrow and you haven't included it in your will, you could miss out on £325,000. Is that roughly right?
Yeah, thereabouts, yeah.
Yeah.
And again, of course, you've not considered about the surviving spouse remarrying, her divorce, her care fees,
Yeah.
her creditor claims. So in fact, all those things can happen before the IHT comes along anyway.
Agreed. So Will has told us why making a will. Will is that's a great. Sorry. So we'll skip that one because I can't say will and will too many times in the same sentence. Make use of your exemptions and make lifetime gifts. You can either gift directly. So today I could say to my kids, if I had it, here's £100,000, outright gift, do your best. And hopefully, if I live 7 years, that will reduce my estate by £100,000 and the tax. But of course, there are problems in making direct gifts. So again, surprise, surprise, gift into a trust so that there is more control. Briefly run through the gifts and exemptions just in case people aren't aware of them, and some of them are overlooked, quite simple ones. So there is the spouse civil partner exemption. if I have a 325,000 personal allowance, nil rate band, and I don't use it, I can pass that to my spouse. We have the nil rate band, as I said. The annual exemption, £3,000. You can make annual gifts of £3,000. If you haven't used them last year, you can actually carry it back 1 year. So you can make £6,000, double it up, husband and wife, £12,000. There's a small gift exemption. You can write out a cheque, or I could write out a cheque to everyone in the room today for 250 quid. Unlimited now of small gifts, £250. Normal expenditure from income, it must be regular, and it must be out of true income, i.e. earned income, dividend income, not capital. So I could fund, because I'm a financial advisor, I could fund pensions for my kids. And those contributions that I put into a pension for my kids are gifts out of income. There is gifts in consideration of marriage, so if my daughter gets married, I could write her a cheque for £5,000. Grandparents could do the same. You could do the same if you want. She'd like it, she'd enjoy it. Charities, political parties, universities, they are exemptions. If you make gifts to them, that's tax-free. And business property relief, I'm not a techie, this is more for the accountants in the room, but if you have a business, if you have a sole trader, if you're a partner, if you are a shareholder with shares in an unquoted company, you will get business property relief up to 100%, as long as the company is a trading company and it's been trading for 2 years. I'm looking for my guru at the front. So if you have got business and you are concerned about it forming part of your estate, then it might not be as bad as you think. Potentially exempt transfers. This is where the donor makes a gift. So I can make a gift to Gary of £100,000 today, and as long as I survive 7 years, that gift will then be out of my estate for tax purposes, and I've saved £40,000 inheritance tax. If I die within 7 years, then that gift could come back into my estate. Gifts in excess of the nil rate band will be subject to taper relief. So if I make gifts up to 325,000, I'm using up my nil rate band. Anything in excess of that, if I die within 3 years, it comes back into my estate 100%, and then you get tapering relief. So in year 4, 80% comes back in, 60% in year 5, etc. So earlier you make it, and the longer you survive, the better. Because we are financial advisors, you can insure against dying within 7 years. So you can actually work out what the tax liability would be on day 1, and take out a decrease in life policy to pay the tax in case it happened. We like trusts because it's one way of gifting property and getting your assets outside of your estate and beyond the IHT net. Don't want to get too technical because most gifts into trust are chargeable lifetime transfers, and they could attract an immediate liability to inheritance tax, which I'll mention in a second. We know that we can control trusts through trustees, therefore we can appoint the trustees and they will look after the gift for the beneficiaries. So which trust? There are basically two. Absolute trust, I'm the set law, I set up a trust and the beneficiaries are going to be my 2 children, absolutely. Once I've done that, I can't change the beneficiaries. I'm basically just looking after the money until my kids say I want it. So there is no degree of flexibility, but they work. The alternative is a discretionary trust, which gives you more flexibility because there's no specified beneficiaries and the trustees can appoint beneficiaries and change beneficiaries in the future. Coming back to this chargeable lifetime transfer, you have to be careful with discretionary trusts because they are subject to inheritance tax. If the gift into the trust exceeds 325,000, which is the nil rate band, then there could be a 20% tax charge on the excess. So just a little bit of care, and we need to talk to you about that a bit further. Oh, that's a terrible colour. Oh yeah, right. These are just some ideas of where we're going. What we find talking to clients is that in an ideal world, they would love to reduce their inheritance tax liability by giving away their estate. The problem with that is that sometimes they can't afford to do it because either they want to give capital, but if something goes wrong, they would like it back, just in case it hits the fan. Alternatively, whilst they're happy to give away capital, they might need income from it. So there is these, these difficult decisions that have to be made as to why, what could stop you from giving capital away, because a gift has to be outright. The gift that you make, you cannot enjoy the benefit of it. So if I give £100,000 to my children as an outright gift, and I want that outside of my estate for inheritance tax purposes, I can't ask for it back, or I can't ask for a loan. That is a gift with reservation, and all that happens is it comes straight back into my estate for IHT. So how do we get around this sort of income and capital? Do we need income and capital? Well, let's go back one step. If we have got no income or no capital available, then all that's going to happen is someone else is going to pay our inheritance tax bill, i.e. our children. There's not a lot we can do about it. Let's say we've got spare income, but we've got no capital. What can we do to avoid inheritance tax? Well, the only real thing we could do is take out a life policy to pay the tax bill. So we could sit down, we could work out what our assets are, what our liabilities are, what our taxable estate is, work out the tax at 40%. Let's say it's £800,000. That's what we think our inheritance tax bill will be when on second death. I'm talking about me and my wife here. And of course, I naturally assume my wife is going to die second. So we can work out that we could take out a life policy for £800,000 sum assured, payable on second death, so that when my wife inherits all my estate, and then she has her estate which is going to be taxable, and someone has to find £800,000, i.e. the executors, my children, they have got a life policy that pays out to them £800,000. Now, some people will think, that's going to be quite expensive. It's not as expensive as you think. I did a case a couple of weeks ago, male 64, female 62, non-smokers, £800,000 sum assured, and the premium was £60 a month. Now, if you knew you were going to die within, say, 12 months, that's a good return on your money, £800,000 for £700 premium. And these are the sort of conversations you might want to have. If you have got capital, as I said, the trouble with gifting capital away is the fact that you might want it back if something goes wrong, and that's a gift with a reservation. If you need income from that capital and you need access, there's not a lot you can do except direct the gift or the investment into a trust, and that will be payable on death, as in a will trust. So I've got that confused a little bit. Let me go forward. I'll have the whole lot up actually, because then it's easier for me. What I want to cover off now is just two ideas of where you can invest some capital and overcome the problem of either wanting to get access to it if it goes wrong or wanting income. The first one is a loan trust. How does this work? I'm the settlor and I gift to my children £100,000 and I create a trust. I'll take a step back, sorry. I create a trust and I lend the trust £100,000. It's a loan, okay? It's not a gift, it's a loan. The trustees take that money and invest it in a single premium investment bond. The loan itself is interest free and I can ask for it back at any time I like. What I do is I ask for that loan to be repaid to me using a 5% withdrawal facility from the investment bond because I need income. 5% per annum is used because there is no immediate tax liability on withdrawals at 5% from investment bonds. And that loan repayment comes back to me as income, and of course I have to spend it, otherwise it just goes back into my estate. The loan outstanding at any time still forms part of my estate. But as it's repaid and reduces, then it's reducing the value in my estate and reducing the inheritance tax bill that is payable. Hopefully, because I'm a financial advisor and I invest people's money, I do a reasonable job. And I tell the trustees to invest that money in the bond and it grows at 5%. It's the growth on the bond that is outside of the estate for inheritance tax purposes. So, as an example, if we put in £100,000 on day one, in 5 years' time, I have taken back £25,000 as loan repayments, as withdrawals from the bond. They've come back to me as the settlor, and I've not paid any tax on that. The bond itself has grown by 5%, so what we have done is the growth on the bond is now outside the estate at 25,000. Run it through over 20 years. At the end of 20 years, I've had back 20 lots of £5,000. So I've had back the loan. It's now repaid to me, and the bond has grown by 100,000. So it's the 100,000 that is now outside of the estate. Probably wrong one. A better way of looking at it is look at a blank. Here we go. I'll skip that one. Here's a 100,000 investment with no withdrawals at all, and it's in a bond. It's not in a trust. And what happens is, as the bond grows, the inheritance tax liability just grows. So if I just take out £100,000 into a bond, not in trust, no IHT planning, what I have is a problem with a growing IHT bill. If I do the loan trust, what in effect I'm doing is I'm capping my IHT liability at 100,000. Worst case scenario, I die on day one, there's still £100,000 in my estate, okay? And the tax is payable at 40%. If the bond now provides these 5% withdrawals, there's your investment bond not in trust, and my IHT liability stays at 40,000. But here, where the loan trust is being repaid, my IHT liability is reducing. As I say, it's no good taking the loan repayments and leaving them in the bank account because they're still inside of your estate for inheritance tax purposes. What if the settlor needs more income? You can actually take more than 5% out of the bond at any time. You might pay tax on it, but you can get access to more income. The settlor, though, cannot get back more than the loan. He cannot get back more than the loan is, and he doesn't get access to the growth. That is for the beneficiaries. So all we're doing is we're putting in the 100,000, capping our inheritance tax liability, and the growth on that is outside the estate, but we can always get our capital back at any time in the future if we need it. I don't see that as a problem, not accessing the growth as the settlor, because really it's going to be for the kids anyway, for some reason. So bear in mind with a loan trust, don't do it too late in life because the loan is part of your estate for IHT purposes, and it's only going to reduce as you take repayments. And if you die in the first year, most of the loan will be in your estate. You must be in reasonable health again, because if you die early, there's not going to be much of that loan outside of the estate. So in summary, you do get full access to capital. You have control as to who's going to benefit. Any growth outside the estate, any growth outside the settlor's estate is not taxed. And it's well used. The other idea, very briefly, is a discounted gift trust. What it does, it actually gives you an immediate reduction in your estate for IHT purposes. An immediate reduction. Unlike the loan trust that doesn't give you the immediate reduction, this could be sort of not deathbed planning, but it could help out in the shorter term. The entire investment is outside of the estate after 7 years, plus the growth. And you take an income for life from the investment until the fund is exhausted, but hopefully it will never get exhausted because we're going to invest it and make money. Best way of describing this is with an example. Here is a lady aged 70. She has £500,000, lucky lady, lying around in cash, and she is quite happy to give that £500,000 away, but she wants an income for the rest of her life. She doesn't need capital, she needs income. And whatever the word is, she sets the income at £25,000 a year, which happens to be 5%. Why 5%? Because the £500,000 will go into this discounted gift trust and a bond, and the withdrawals of income of 5% are not taxable. So the 500,000 goes in. What we then do is we value, or we put a value on these future income withdrawals she is going to have. And this is actuarially calculated based on her life expectancy. And this is a real life case. So if this young lady of 70 puts £500,000 into a discounted gift trust and wants £25,000 a year, the value of that income is £283,000. Now that is a discount immediately from the gift of £500,000 that she has made. So for inheritance tax purposes, that comes out of her estate on day one, immediately. And it's only that figure that is the chargeable lifetime transfer assessed to inheritance tax if she dies. I won't go too much into how the discount works, but I equate it to an annuity. If I wanted an income for life today, I could buy a purchased life annuity, and if I wanted £25,000 a year, the figure might be £280,000, and that is outside my estate immediately. Yeah, I've bought an annuity, I've given an insurance company £283,000, that's gone outside my estate, and that's the value of the discount. I get the income for the rest of my life. Why isn't it a gift with reservation? Again, it's a slight technical issue, but the settlor, me, actually carves the right to this withdrawal from the bond, that's a capital redemption bond, prior to it being settled into the trust. I retain an absolute right to that income for the rest of my life, but I'm not entitled to the capital. There's a case that went through the courts, and it was relevant because retaining income prior to settling capital into the trust avoids the gift with reservation rules. It is a tried and tested formula. So, in a summary, a discounted gift trust. You create a trust, you make the gift into it, you get an immediate discount on the IHT, on your IHT liability, and you get an income for life from the fund. The remainder of the fund is invested and hopefully grows, and on death, the balance of the fund goes to your children. All the growth is outside the client's estate for inheritance tax purposes. Be warned, you can't change this. Once you've set this up, you can't cash it in, you can't change the income. You have given away an amount of capital for life in return for income. The actual value of the gift is calculated on the life expectancy of the individual and the future, and the value of that future income stream. So obviously if you're in bad health or you're getting on a bit, you're not going to get much of a discount. No IHT if the client survives 7 years, it's straight outside the estate, and you do have control. Finally, I just put that on there because for those of you who are into enterprise investment schemes and investing in these sort of new startup businesses, if you hold an enterprise investment scheme for more than 2 years, it's outside of your estate for inheritance tax. Bonds and care homes, and this goes back to Will. We are wealth managers, we look after clients' investments, and a lot of the times we use investment bonds. As far as I'm concerned, if you go into care and the local authority pop up and you knock on your door and want to assess you for care fees, and a life bond or an investment bond is not assessed or means tested for long-term care because it is a life policy. Is that right?
Correct.
Good. So So that's that one. So if you have got money, don't put it in OICs and unit trusts. If you're going into long-term care, put it into investment bonds. The second one is a very simple one. We're talking about inheritance tax. Apart from the house and the business, hopefully, the other main asset a lot of people have got is a pension fund. And most of them would have something like this. If I die, the trustees say, who's your nominated beneficiary? And 99 times out of 100, they'll fill in a form and say, if I die, I want my spouse to be my beneficiary. That's not a problem for the pension trustee. You die, your wife gets the money. But of course, then on her death, your pension fund is sitting in her estate and it's going to be taxable at 40% over the nil rate band or the doubling up. So why don't we create a trust? And it's called a spousal bypass trust because the benefits from the pension scheme bypass the spouse, go into the trust, who now owns the money. The spouse can be a potential beneficiary, the children can be potential beneficiaries, but on the spouse's death, it doesn't form part of her estate for her IHT planning because it's in a trust. So one little bit of free advice, to coin your phrase, if you have got pension benefits and you're worried about IHT, use a spousal bypass trust. Thank you.